given that we're primarily an entrepreneur's advocate, we kind of look at the balance of trade in terms of the economic sharing between the private equity firms and the entrepreneurs. And I'd say that the entrepreneurs are really losing the race for the most part. The preponderance of the economics are going to the financial engineers and the private equity folks.
Welcome to the Fueling Deals Podcast, the podcast that teaches how to accelerate your business growth through all types of deals. It's time to fuel up, so buckle in with your host, Corey Kupfer.
There are only two ways to grow your business: organically through sales and marketing and providing great products and services, and inorganically through deals. Too many companies focus only on the first way, organic growth. Welcome to the podcast, which will help accelerate your business growth inorganically. My guests are a huge variety of deal makers and experts on all types of deals who have personal experience that can help you grow, get clear, learn best practices, and avoid mistakes. We discuss everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My guest today is Dan Seivert. Dan is the CEO and founder of ECHELON Partners, one of the leading investment banks and consulting firms to the wealth and investment management industries. Over his 24-year career, Mr. Seivert has advised on more than 400 M&A assignments, valued over 1,500 companies, and evaluated more than 2,000 acquisition targets. Listen, the rest of Dan's bio is going to be in the show notes. You should check it out. I mean, he serves on boards. He's got, major publications and white papers out. He's, I've known Dan for, over a dozen years in this industry, and he's really one of the leading investment bankers in the space. And Dan's been a good partner and friend in the industry, and he runs this great conference that we're going to talk about. So he's going to bring a lot to the show, I'm sure. Dan, it's great to have you on the show.
Hi, Corey. It's great to join you, and congratulations on kicking off this highly value-added show, Fueling Deals. And it's a pleasure to be one of their first speakers and to help you and your audience with a very important subject related to growth and entrepreneurship.
That's great. So listen, I'm looking forward to talking about what you see in the industry and the kind of deals that are going on now, what you're working on, and all the value you can bring the audience. But I want to take you back first with a question that I've been asking on the podcast, so people can get to know you, which is, so when you were growing up, Dan, when you were whatever it was, 6, 8, 10, 12 years old, what did you want to be when you were growing up? Because my guess is an investment banker in the wealth and investment management space was probably not it at that time, but you tell me.
Well, I grew up doing a lot of outdoor sports, which included surfing and a lot of time down at the beach. And I thought the ultimate job would be a meteorologist, where I could help people understand the weather, and as part of that, be very in tune with what's going on with the waves down at the beach.
Oh, I love that. I love that. And I know you still, I know you're a big cyclist. And so despite your, busy schedule, you still get some of that outdoor activity in, right?
I do. And I often wonder what my life would be like if I were on the TV having to compete with today's meteorologists. I think it would be a tough time, because the profile has changed quite a bit since Dallas Raines and Johnny Mountain, who were the meteorologists when I was growing up.
Well, the one advantage, though, to it would be that apparently they have a job where they can be wrong 50% of the time and still have a job. You and I couldn't do that in our businesses.
Well, yeah, and it's pretty tough to be wrong in Southern California.
Well, that's true. You see, you're right. That was an East Coast guy comment, even though I spent half my time in Southern California now. On the East Coast, there's much more variation, and they tend to get it wrong a lot. So, Dan, my other question before we get to the present day is, what was your first real business, however you define that? Was that Echelon? Did you have businesses when you were a kid or in college? Or, what was your first real business?
Great question. So I grew up a few houses from a fairway on Glendora Country Club, and the first business was to walk around the golf course and find golf balls, and to also go in the lakes and find golf balls, and then to put those into egg cartons, and that we would sell those for $1 each as the golfers went from the front nine to the back nine. And I think by the age of of 12, I had about $5,000, and that was enough to easily buy my first car and, do other things that I wanted.
Oh, I love that. I love these early entrepreneurial stories. So that's fantastic. So Dan, just give us a few minutes on Echelon. I mean, at a high level, we already talked about it. You guys being really one of the leading investment banking firms and consulting firms in the wealth management space. But talk a little bit about the different things that you do for clients in the space.
Sure. So Echelon was founded 18 years ago, and it was the general concept was to serve 3 sub-industries within financial services and to offer them 3 core products. So the 3 target markets, if you will, that we were focused in on and still are, were investment managers. So anybody that was involved in developing an investment product and principally involved in the activity of choosing stocks and bonds or other investment vehicles and packaging them for sale to retail advisors or to offer portfolio management to endowments, foundations, and corporations. The next group is wealth managers. And so those wealth managers were oftentimes using the products of the investment managers. And they too came in all different shapes and sizes. We work with wirehouses and the advisors that work for wirehouses. We work for RIAs, financial planning firms, single family offices, multifamily offices, and any type of an RIA or wealth manager that works in a law firm, an accounting firm, an investment management firm. So they come in all different business models. And then the last group is wealth tech firms, which are principally the technology-oriented firms that are really connecting either wealth managers or investment managers to the rest of the industry. In terms of the services that we offer, the first is valuation services, where we help firms understand valuation in a lot of different contexts. It's not just in a buy or a sell transaction, but also related to bringing on new partners, the exit of partners. It could be the sudden death of a partner. It could be raising capital, whether it's debt or equity. A lot of people think that each firm has one valuation, but in reality, firms have many valuations based on the context and the situation. I think the next area is really consulting services. And there we offer strategic planning, assistance with succession and continuity planning, help with growing pains as firms move through different business cycles. And then our number one solution is help with equity sharing programs, which is an interesting sort of in-between of the valuation work and the investment banking work that we do. Oftentimes, entrepreneurial firms struggle a great deal with how to share ownership. And given my involvement and history in private equity, I have a lot of experience in helping entrepreneurs overcome those challenges. And we've trademarked a couple of different solutions, one of which is called dynamic equity sharing, which has become very popular in the industry and allows equity to flex as the contributions of the partners change over time. So the final area is investment banking, which is oftentimes a big word for the wealth management space. But we principally help entrepreneurs with buying firms, selling firms, merging firms, and then doing transactions between each other. So this encompasses a typical life cycle of preparing marketing materials, as well as understanding who the buyers and the sellers are in the space, help assisting with deal structuring, tax advisory, negotiating the transaction, and then we also prepare letters of understanding, which we hand off to legal experts like yourself to finalize and close the transaction. So that's a general overview of who we're serving and how we help.
So that's great. So I want to pick a comment. There's so much we could talk about, and you and I mean, with all the expertise and all the deals you've done, we could talk for hours. But obviously, in a podcast, we have to sort of pick and choose. So I want to hit a couple areas that are of interest, and maybe haven't covered quite as much. So the equity sharing conversation. I really want to delve into that with you, Dan, because it's interesting. There are different models out there in the industry, right? There are firms where they share equity a lot and true equity across various people. There are firms out there that where there's one owner, and even large firms, right? Where maybe they use some sort of phantom equity, a synthetic equity program. And there's everything in between. So when you advise firms on their equity sharing programs, what factors do you take into account, and where do you come out on the spectrum of true equity versus synthetic equity, and what circumstances you should share equity or not share equity, and how do you help clients figure that out?
Well, I think there's a lot of questions in there, Corey. So let me see if I can unpack that, so to speak. The first thing is to understand that equity compensation is a part of a larger compensation package, which usually includes base compensation, bonus, benefits, sometimes profit sharing plans, and sometimes retirement plan benefits as well. So the equity sharing portion is usually that advanced piece that is done last and is reserved for the most valuable employees or partners in the firm. The way that we figure out how much equity sharing makes sense is to first identify who's adding the value in the company and how much value was initially added by the founders. So we always view there being kind of a foundational development of the company and setting up of the firm. And we want to make sure that the founders and the original entrepreneurs and the risk takers and the ones that provided that initial risk capital have a reward that is commensurate with that profile. As firms develop, the risk oftentimes goes down and there's more economic proceeds to share. And so we look into the different partners and see what's their pro rata contribution to the firm. And there's really, after the founders, there's really two types of contributors within wealth management firms and frankly investment management firms. For the wealth managers, it's those advisors that are doing the rainmaking and those advisors that are doing the client service. Beyond that, there's a host of other professionals that help the operation or help the organization with its growth and its development and just running smoothly. Oftentimes that's the chief legal officer, the chief investment officer, the chief marketing officer. There's somebody who's the head of technology, operations, HR, and then compliance is sometimes bundled, and there might be a marketing officer if I didn't mention that already. So having some sense of the relative contribution of those professionals is a really good starting point. And then understanding where the founder group wants to go with equity sharing and where they are presently is also a good way or a good set of touchstones to look into. So what we oftentimes find firms that are getting into the $1 billion range is 1, 2, or 3 founders that have principally shared the ownership equally between each other. And now they want to begin sharing it with the next gen partners or the next wave of value contributors. And oftentimes the metric that they're working with is sharing 5 or 10 or maybe 15% of the organization. So the ways that people often contemplate sharing the equity is, do I give it away or do I make these next gen partners buy it? And if it's given away, what's the tax implication? And if they buy it, what's the valuation, and how do I get capital in their hands to be able to make the acquisitions, or do they need to go to the bank? And that's how we start to originally gauge the sizing, and also we do some cash flow analysis to help the founders understand what amount they would get back in the transaction, and then to help the next gen partners understand what their base, bonus, and profit sharing, as well as distributions sharing, would mean to them, and then factor in the amount that they'd end up paying off for the loan, the principal and interest, so that they can get an after debt servicing estimate of what their cash flow would be, and also after tax estimate, so they can manage their affairs and they can understand the benefits and the costs associated with a transaction like that.
So let me ask you something on a specific point you made, because I tend to be in one camp on this, not a hard and fast rule, but I tend to lean heavily. And that is that, that decision on whether you have your people pay for equity or whether they get equity, true equity. And I tend to, and feel free to disagree with me. You don't have to agree with me. I tend to lean heavily towards, having in this industry, having people in any industry, having people pay for equity on the theory that if they don't pay for it, they don't value it as much. And unless you've been underpaying them, if you haven't been compensating them well, like outside this industry, like in tech firms where people are going to take a lot lower salary for the upside and whatever, that's different because part of their comp is equity. But in this industry, if you've been paying them well, my sort of view is, well, they should, with some exceptions, they should more often than not buy in. Agree or disagree?
Generally speaking, I strongly disagree. I think
great.
The reason is that buying into a firm is a very tax-heavy endeavor, and there's ways to structure it that you can significantly reduce the taxes. And the way that the general flow goes is that if you wanted to sell me $100,000 worth of equity, let's say your firm is worth $1 million and you wanted to sell me 10%, and you think you're going to extend that privilege to me, but my compensation is only $200,000 right now, and after tax, it's probably closer to $120,000. And
right.
So that is, it's going to be tough for me to make that $100,000 acquisition. But let's just say that you wanted to do that and you're going to help me out. And so you're going to, you had to bonus me the amount necessary to do that. So you'd have to bonus me $170,000. I'd pay tax on that. That gets me down to $100,000, in which I could pay you out. And then once I pay you, you're going to pay capital gains on that. So that's going to leave you with $65,000. So you just bonused me $170,000 and you only got $65,000 back, and the government got $105,000. And there's another way to do that transaction where I can basically cut the taxes in half, and without sort of giving away the secret sauce.
Sure.
We know how to do this, and it's very attractive and of great interest to our clients. And it's good for you. It's good for the next gen partner, and we're not necessarily paying as much taxes. So it's a win-win-win.
Well, that's great. And listen, I do agree. If you're going to bonus them the money to pay you, that doesn't make sense. I totally agree. And listen, there are, unlike only 5-7 years ago, even, there are a lot more lending options available for these types of transactions than there ever were. Right? I mean, that's one benefit. Where next gen, 5-7 years ago, next gen had very few options to be able to get funding for these type of deals, but there's at least I'm finding there's more options these days, at least, right?
Oh yeah, definitely. I think prior to 5 years ago, the only way to get things done was through a seller note, and there's actually some pretty good advantages to seller notes, but most of the disadvantages accrue to the seller, and so the financing options have been. There's some specialists, probably 5 to 10 more common options, and beyond that, in terms of community and regional banking, there's probably another 40. But that's up significantly, and that's making transactions a lot easier to do. And frankly, it's really contributing significantly to the deal volume, as your show would suggest. It's fueling deals, and perhaps no other element within the wealth management industry has fueled deals more than the availability of capital under I think, reasonable terms, and the process has become significantly easier to go through as well.
Yeah, I think that's been a huge change in the industry. I want to jump back to one of the areas you talked about, because we haven't covered it as much on the show, and I think it's important in the industry, which is the whole wealth tech, fintech space. Where there have been a number of deals and where companies have tried. I mean, you look at somebody like United Capital, who basically try to create a fintech play within United Capital to try to increase the value. You can make an argument on whether that had any play in terms of what Goldman Sachs paid for it, or what you think about the deal in general. I'm not asking for a commentary on that particular deal, but it's an example. Talk to me about what you're seeing in terms of fintech deals, in the industry, and it seems like there's more of a volume of those, and the tech side in this industry is also a growing area.
Right. Well, I think the way that we look at what we call it wealth tech, because it's the subset of the fintech space that specifically relates to the wealth management industry, and that's a term that we coined kind of in the beginning of the trend.
Yep.
But what we like to think wealth tech is kind of like the different modes of transportation, whether it's planes, trains, automobiles, or scooters. It's just another element that's facilitating the growth and development of the wealth management industry. And I would say that it was very big in the late 90s when I was working as in private equity, and it sort of ebbed for the next 6 years. But once we came out of the financial downturn in 08 and 09, it's really had a rebirth and has become a very significant part of our industry. I would say that there's a couple of key themes and ways that firms are playing the space. There are single sleeve specialists, if you will, that are focused on one element, be it portfolio accounting or CRM or account aggregation or portfolio management or tax rebalancing. So there's a whole bunch of different sleeves. That's one play. And there's companies that have that business model. And then there's more of the aggregate play, where you're taking more of a Microsoft Office approach, and you're trying to put together a suite of solutions such that the end consumer gets everything done within your brand and all the sub brands, which kind of equate to Excel, Word, and PowerPoint. So the players like that include Orion, increasingly Morningstar, SS&C, Envestnet, and those providers are looking to be a one-stop solution and to add a lot of value in terms of the integration of their solutions. So it's been a great opportunity for entrepreneurs to specialize, and then also the best firms that are specializing in any particular area become strategically important to those who are building the universal solution. So we saw eMoney was an early example of a specialist that traded at $300 million, and then Money Guide Pro recently trading for $500 million, just shows the wealth creation opportunity that's available for entrepreneurs specializing in tech solutions for the wealth management industry. So I think it's very exciting. It brings an element of change to the industry. It's forcing everyone to up their game in terms of the user interface, the solutions that are offered. And it's really putting a lot of pressure on those firms that are the owners of the technology suite, such as the larger firms like the wirehouses or the independent broker-dealers, Cetera, LPL, Merrill Lynch, Morgan Stanley, as advisors are choosing to work with the firms that have the best suite of solutions. So it's fun in that it introduces a lot of change, and it's also a catalyst that causes everybody to become better as they try and keep up with this constant evolution of technology.
So it's interesting, Dan, as I think about it, we've talked about a couple of trends that have really affected the industry so far, which is, the wealth tech, what we just talked about, and then also the increased availability of capital. Mainly, we were referring previously to loan capital. But the other thing that's happened, right, is that there's been a lot more private equity and venture capital money that's come into space. And then, of course, we have, firms like Focus Financial going public. So, for me, these are all signs of what's really a maturing industry. And you see these kind of things happen in other industries that have been maturing. So what do you see in terms of, that increased money in terms of the private equity venture capital side of things and the funding of the aggregators and the impact of that in the space?
I think it's a funny paradox because, we track the private equity involvement, and I think that the number of PE firms that are backing robo-advisors is over 100, and the number of PE firms that are backing just general wealth management firms, whether it's a single RIA or a roll-up firm or it could be a broker-dealer play. That too is over 100 private equity firms. So over 200 private equity firms that are in the industry. I think, given that we're primarily an entrepreneur's advocate, we kind of look at the balance of trade in terms of the economic sharing between the private equity firms and the entrepreneurs. And I'd say that the entrepreneurs are really losing the race for the most part. The preponderance of the economics are going to the financial engineers and the private equity folks. And what's funny is that, and the reason why I said it's a paradox, is that there's now so many private equity folks involved that they're the ones that are driving down their own returns as they compete for deals. I think all the while, the entrepreneurial wealth managers, for the most part, are still losing as they leave way too much money on the table in their deal making. But I think overall, the private equity investors are creating some attractive liquidity options, but they could be way more attractive if the entrepreneurs understood a little bit more of the way that private equity valuation works.
Interesting. And talk to me a little bit. This is like a favorite topic of mine. I've seen it in other industries, and I've sometimes been quoted in some of the press around this, which is the whole, as money comes in, because obviously one of the things with private equity, and you're very familiar with that space, comes in is that, capital, there's pressure to deploy capital, there's pressure to grow, there's pressure to create returns, there's pressure, there's usually a time period, whether it's 5 years or 7 years or 10 years, but usually more like 5, 7. Where private equity wants to be able to exit and capitalize on their investment, and that creates certain incentives, and it raises the conversation for me always of deal discipline. And do you have a view of what you've been seeing out there in terms of deal discipline? I'm talking about like the firms that are funded and who are buying now, using that capital to buy more firms. In terms of are they overpaying? Are they doing good deals? Or, and we're not talking about anybody in particular, but what do you see in the industry in terms of deal discipline and the need to deploy capital?
It's a good question. I like the language that you're using to describe that, because deal discipline to me really relates to a strict adherence to a certain deal profile and a commitment to doing a certain volume of deals in a certain time frame. So what that sounds like is we're only going to do billion-dollar transactions for firms that focus in on clients with more than $1 million in investable assets, and we're going to do 3 of those a year and get approximately $4 billion of transaction value done each year. Overall, I would say that the deal discipline is more flexible in the wealth management space than what I've seen in other industries. And I think that is kind of a requirement because as you've advised different wealth management firms, you've recognized that to a certain extent, each of these is unique, like a snowflake. And maybe if you were real generous, you could kind of bundle them into 6 different business models. And so I think being flexible is almost a requirement to doing deal making in the space. And so deal discipline, if you tried to go after that rigorously, I think you'd be frustrated and have a hard time with that. And so I think that bodes well for the entrepreneurial advisor, because I think they get more looks, and I think fewer people, and we see this in our deal processes, few people are quick to fold and say that doesn't fit, and we see more of a situation where people are at least willing to give it a look and a consideration, and to maybe flex their criteria a little bit to make things happen out of recognition of the fact that there's so many unique firms out there doing things in their own way.
Yeah, no, I think that's a good point. I agree with that. What about around valuation and pricing? Because sometimes when money comes into a space, there's a pressure to get deals done, and they lose discipline around making good deals in terms of pricing. Do you think the firms are doing a pretty good job of making good business decisions these days, or do you feel like there's any inflation of value because of the need to deploy capital?
Well, I would describe it as wealth managers are selling dollars for 40 to 70 cents. And so, for buyers, that's a great thing. They'd be buying those dollars all day long. But for the selling entrepreneurial wealth manager, it kind of makes you shake your head and say, I don't get it. But I think we explain it that kind of as like the perfect blind spot for advisors, and that because they know wealth management, they think they know corporate finance, and they don't understand the difference, and so they oftentimes don't see. They think they're selling dollars for a dollar, but that's definitely not the case.
I love it. So, what I hear you saying, Dan, and then listen, listeners, this is an important point. Despite the additional capital coming into the space, where sometimes that could cause a run up in firms overpaying. I mean, what I hear Dan saying is that a lot of firms are still getting underpaid by the professional money, and that definitely. I mean, he doesn't need to say this about himself, but I'll say it, that you want to get somebody like him involved in these deals because they understand the investment banking, the finance, the VC world, the private equity world, and where there may be some more room to get you some more economic benefit in a deal like that. So I think that's a great point, and we may not, that gap, that opportunity may not last forever, right? The more and more money that comes in, the fewer deals that there are. Sometimes that shifts. So it sounds like it's a good opportunity to take advantage of that at this time.
Yeah, I mean, just by contrast, observe what it sounds like if I were to say the sellers are selling dollars for $1.20.
Right.
That just sounds, that sounds like it might be more commensurate with the supply and demand that should be going on in the space, because I think conventional wisdom is that there's a lot of buyers with a lot of capital, and there's very few sellers. And that describing something being trading at a premium price is more in line with what should be going on, but it's not.
Interesting. Fascinating. So then, are there any other, I'm just going to ask you a general question. Is there anything else that you think our listeners should know about what's going on in the M&A space, in the valuation space, in the equity space, and all those things that you do? Any big trends or any things that they might be surprised about, or anything you think would be valuable for them to hear?
I think yes, it's important to understand that kind of behind the scenes, there's this pendulum going back and forth between internal and external deals, and I think for the most part, internal deals represented somewhere in the mid 40% of all deals. And up until, say, about 2 years ago, that was increasing to the point where it got probably close to 60% of transactions were moving to internal deals. But as firms have been getting bigger, and as the business cycle has gone on, and there's been more of a focus on the fact that there's some discounting associated with the valuation of internal deals, and they're not always the easiest to pull off. The pendulum has recently swung back and is moving in the other direction to favor external deals. And this, sort of back and forth is something that it isn't really that well known, but that we keep track of. And it definitely is kind of part of almost like the auto nervous system of the wealth management industry to understand, kind of some of the biorhythms of deal making. And we think it's important to keep track of, and also to have that conversation with our wealth management clients because I think one of the first questions they ask us is to figure out what's the difference between an internal succession transaction and a sale to a third party. What are the advantages and disadvantages from a legacy, a people or human capital standpoint, and from an economic standpoint? And if there were, one main subject or issue that sort of encompassed all the things that we've talked about so far, it's really that, because it brings into play valuation, equity sharing, the types of buyers and transactions that you'd be doing, the roll-up firms, private equity, as well as I think the final one was financing. All those come into play with respect to that tip of the arrow issue. So in terms of a topic for fueling deals, that's a key trend and a very important one.
So that's great. So before I ask you my final question, I want you to give people an opportunity to know where to reach you, because I'm sure they got huge amounts of value. And before I turn it over to you, I want to give though a plug here, and I'll let Dan talk about it a little more. But Dan and his firm Echelon run this Deal and Deal Makers conference for, what is this going to be, Dan? The 8th or 9th year coming up, something like that?
It's the 9th edition and the 8th year.
Got it. So the 9th edition, I've had the pleasure of attending some of them. In fact, in the years where I've had some sort of conflict and couldn't make it, I've been very disappointed, because it's always really, there are a lot of big conferences out there that the custodians put on and other people put on, and Dan's conference is a conference that is smaller in a great way, because it's a focused group of people who are interested in deals and deal making in the space. And he's got, he always has phenomenal people there. So the next one's coming up, what is it, September 3rd and 4th, Dan?
That's right, in Newport Beach.
Great. So September 3rd and 4th, Newport Beach. So if people want to find out about that, I'm definitely going to be there. Folks, you should definitely come. It's a phenomenal conference. If people want to find out more about that or your firm in general, what's the best place for them to go, Dan?
www.dealsanddealmakers.com, or they can go to the ECHELON-partners.com website and learn more about it there as well.
So that's great. So I'm really looking forward to this year's summit. Like I said, Dan does a great job with that, and obviously, folks, you've heard the various things that he does, and he and his team, and he's got a phenomenal team as well, do in the industry. So definitely reach out to him. Huge amount of knowledge and background there. So Dan, my last question for you, which is the last question I always ask on the podcast. You know me well enough to know that authenticity is a very important value of mine. In fact, my book is, a couple of years ago, I had the pleasure of speaking at Dan's conference and doing a book signing around the time when my Authentic Negotiating book was released. Authenticity is a big value of mine. And I always like to ask my guests, in terms of, for me, authenticity means alignment with our values and ourselves. It's not about some external morals or integrity, but it's about making our life and business decisions and doing our deals in a way that's aligned with, who we are and what's right for us. So I'd love your take on that and how that may affect the way, you advise clients and what authenticity means for you in terms of the way you do business.
Well, I love the concept, and I'm congratulations on completing your book, and it's great to partner with you, Corey. And that's a authentic communication and authentic deal making is very aligned with our core values as well. It makes me think of the importance of human capital in deal making, and I think people maybe overuse the importance of culture and maybe underthink what comes maybe a level down from that, which is human capital. And it's certainly an area that we work hard to cover in the Deals and Dealmakers Summit, and always have a special session devoted to that. But if you look at the buyer and the seller, or the two parties that come to a table, oftentimes maybe the bubble over their head is filled with a dollar sign or with some financial elements. But we find that some of the most successful deal making actually has people that are more in tune with the emotional intelligence associated with the deal, that their focus is to do a quality transaction first and let the numbers work themselves after that. It's partnership first, and it's building a great firm that comes ahead of the growth. And that sometimes when you put the growth first and you don't look enough at the people, particularly in the wealth management business, then things become misaligned and you run into more challenges than are surmountable, and sometimes the deals can come unraveled. So I think as a overarching concept, authentic communication, authentic deal making is really a great banner, and something that we can all learn from and be in tune with in our deal making. And I appreciate you elevating it, Corey.
Well, I appreciate you saying that, Dan, and I really appreciate having you on the show. I'm glad we were able to get this together. It's been great to have you as a guest.
My pleasure. Thanks for the opportunity, and best wishes for you and your team for the rest of the year, and for all your clients that have the privilege to work with you.
Thanks, Dan. And thank you, Fueling Deals listeners, for tuning in. Remember, there's only one difference between companies that grow inorganically and those that don't. And it's unrelated to size, amount of capital, or any other factor, other than that the owners and executives of companies that do deals make a decision to do deals, and then they take action. Well, it's time to refuel. So until next week, Corey Kupfer signing out.
Thank you again for tuning in. Be sure to leave Fueling Deals a rating and review on iTunes and Google. Check out all our episodes at fuelingdeals.com to find out more resources to accelerate your business growth.